Everyone, welcome to another episode of the Tech Behind FinTech. I'm your host, Nnamdi Osuagwu. Great to be here. Happy Friday. We are live from Facebook, LinkedIn, YouTube, Twitch, and we're also live from um, IG, Instagram. Instagram's different because we're streaming from the mobile device. So if you want to see the actual show and the slide decks, go to the techbehindfintech.com or go to YouTube or LinkedIn. The links are pinned in Instagram. On that note, we will start the show on our regular platforms. Feel free to comment, ask questions, and so forth. So what are we have on the agenda today? Let me pull up our first news article. So cool. First one we are going with today is Alkami tapped ORNL Federal Credit Union banking for a digital upgrade. Hold up, let's see what's happening here. So ORNL FCU Federal Credit Union will deploy the vendor Alkami's platform solution to power its growing digital offering with money movement, credit monitoring, online loan applications, and Bitcoin services set to be rolled out. The Tennessee-based credit union says its digital channel has seen a 24.2% increase in usage over the past 2 years, bringing its active participation rate to 57% across its members base. The Alkami platform provides financial institutions a complete digital banking solution ready to facilitate both retail and business user onboarding, engagement, and account servicing. Clients can enhance the platform with upgrades and can tailor their experience with additional Alkami products as well as third-party solutions. So Alkami is a fully hosted platform. On their back end, they seem to use Amazon Web Services, which supports their maximum availability and resiliency and provides industry-leading security. Pretty interesting stuff. I mean, it's what we're basically seeing, right? So this is more of a smaller bank looking to start to leverage their digital transformation path, and they're using this back-end system platform. So it's interesting because the actual platform they're using is built on top of AWS. Like so many other fintechs, whether it's AWS, Azure, or GCP, it still leverage some sort of public cloud back end. So find that interesting. That definitely fits within our Tech Behind FinTech. So ORNL FCU was established in 1948. It's now worth more than 3.3 billion and has a membership of 185,000 across 19 counties of East Tennessee. The first one we're looking at. Next article. This was interesting. The Consumer Financial Protection Bureau, the CFPB. So let's get a history right. They're basically leveraging unused aspects of the Dodd-Frank Law to basically scrutinize FinTechs. As we talked about last year, that was one of the bigger banks concerned that FinTechs, it's not enough regulation and so forth. So the CFPB was established it was actually part of Dodd-Frank, and that in the establishment that came out around 2009 or so. That law was introduced because of the collapse of the markets. So let's get into it. So as of it announced, the CFPB announced yesterday, April 25th, that it will start using a largely unused legal provision to examine non-bank financial companies, FinTechs, that pose risk to consumers. The authority gives us critical agility to move as quickly as the market, allowing us to conduct examinations of financial companies posing risk to consumers and stop harm before it spreads. That's from Rohit Chopra, the CFPB director. So the impacted fintechs include non-bank entities in the mortgage, private student loan, the pay and payday loan industries. A second category, they said, larger participants providing consumer financial products and services, operating in consumer reporting, debt collection, student loan servicing, international remittances, and auto loan servicing markets. A third category, initially implemented through a procedural rule in 2013, for which the CFPB has now begun to invoke, covers non-banks of any type whose activities pose risk to consumers. Um, the final category would be more agile and supervised entities that are fast growing or those in markets outside the existing non-bank supervision program. The regulator recently brought legal action against the remittance paytech MoneyGram, alleging that the company failed to deliver funds promptly to recipients abroad, leaving families high and dry. It claimed MoneyGram has dismissed as meritless. See who else is joining on. Have some people joining on Instagram. Welcome. So, real quick, on Instagram, once again, go to the Tech Behind FinTech. You can actually see the video live. We stream on LinkedIn, Facebook, and YouTube, and then you can see our slide decks and different notes that we're putting together. All right, just want to leave that message because people are joining in from that platform. All right, what do we have next? Robinhood announced this week that they're laying off 9% of their full-time employees. So let's talk about that. So Robin announced a move to employees at a company-wide meeting, citing duplicate roles and job functions. During 2020 and 21, Robinhood's net funded accounts grew from 5 million to 22 million, and its revenue shot up from around 278 million to more than 1.8 billion in 2021. In order to keep up with its growth, the company's workforce expanded from 700 employees to nearly 3,800. So now, after carefully considering all of these factors, we determined that making reductions to Robinhood staff is the right decision to improve efficiency, increase our velocity, and ensure that we are responsive to the changing needs of our customers. Tennis says the company's finances are robust with more than $6 billion on its balance sheet. To keep it that way, we are being responsive to changes in the way our customers invest, especially during this time of global conflict, economic uncertainty, and high inflation. So I know we reported last week on the crypto space. Was it last week? I think on the crypto space, Shiba. That was like a big thing with the Shiba coin being put on Robinhood. So the Shiba Army was extremely excited. We definitely talked about that. So that's an update on what's going on Robinhood. Let's move on now. All right, news on Goldman Sachs. So they're offering their first Bitcoin-backed loan. The title of this article is "As Wall Street Embraces Crypto." Goldman Sachs is offering its first Bitcoin-backed loan, showing further signs of increased interest in cryptocurrency from Wall Street institutions. A spokesperson from Goldman told Bloomberg that the multinational investment bank had lent cash collateralized by Bitcoin owned by the borrower for the first time in Goldman Sachs history. She added that the deal was particularly interesting because of its structure and 24-hour risk management. Such loans allow for a Bitcoin holder to borrow fiat. When they say fiat currency, they mean cash that you're all used to. We have a comment from the audience. Let me get through this article, and then I'm going to jump on the comment from the audience. Fiat currency such as United Dollar by fronting up their BTC as collateral. So basically, you're using your Bitcoin as an asset, the same way you could put, like, when you take out a mortgage, you're using an asset, the home. So and the Bitcoin is basically backed, is backing the loan. So if due to the price fall, if the price of Bitcoin drops too far, the borrower may be required to increase their collateral. That Bitcoin fluctuates. So basically, if that price goes down to certain levels, the borrower just may have to add additional collateral to back the loan. Otherwise, they risk getting liquidated. On Wednesday, a multi-trillion asset management firm BlackRock announced the launch of a blockchain-focused exchange traded fund, ETF. Earlier this month, the firm also announced its involvement in a 400 million funding round in partnership with Circle, the principal operator of the USD coin. That's a stable coin. All right, let's take a pause from the article because we always like to engage with our audience first. So Jason, my man. All right, we have a comment. Infidelity is hiring 12,000. Difference between a capitalized full service firm and a one trick pony funded by hedge funds. I mean, that's definitely an opinion of what's going on. So basically, this was on what we just reported. So earlier on, Robinhood is laying off 9% of its workforce. And a comment from the audience, Jason, saying that Fidelity is also now hiring 12,000. So he's making the difference between a well-capitalized full-service firm and one-trick pony, meaning Robinhood. So interesting comment. I don't know. That's one way to look at it. Another way, look, 2020 for a lot of businesses, it didn't work out. But for some businesses like Robinhood, like the Netflixes of the world, like Amazon, I mean, it was just so many people at home, so many different things going on, and their profit shot through the roof. I know certain healthcare companies actually, certain they skyrocketed, and then the following 2 years or the following year, profit shot down. So I think they're just adjusting to market conditions. I mean, who knows? I don't want to speculate, but thinking about it, was it a rush to scale up that big, thinking that that ride's going to last forever? Who knows? But definitely see your point. And always look, thanks for commenting. Really appreciate all the comments, questions, feedback, even insight. Feel free to continuously drop them. If appropriate, I will post them up so that everybody can see it. Jason, thank you very much. Really appreciate that. All right, we're gonna move on to the next article. Before we go on, right? So part of that Goldman Sachs article, he said, we talked about El Salvador previously. So El Salvador is currently in the process of securing financing for its volcano bond, a Bitcoin-backed government bond that will be used to amass $1 billion in funding for the development of Bitcoin City and to increase the size of the country's BTC reserves. That's going to be interesting. We'll be following that because that's something I think we'll be talking about in the upcoming months, definitely upcoming months for sure. So it'll pop back up. All right. It kind of leads into this next one. This next story found interesting. So the Central African Republic will adopt Bitcoin as a legal tender. The roughly 5 million residents of the Central African Republic, or CAR, will now reportedly be able to use Bitcoin in addition to the country's franc as legal tender. So according to a Wednesday report, the news outlet Agence France Presse, Central African Republic president announced that he signed a bill into law establishing a regulatory framework for the use of cryptocurrency in the country, as well as adopting Bitcoin as a legal tender. So we know that El Salvador did the same, and other countries are following suit. We talked about that previously. The president's chief of staff said that the move was aimed at making CAR one of the boldest and most visionary in the world. Lawmakers reportedly unanimous. They all approved that crypto bill, which was introduced to by the country's Minister of Digital Economy. The interesting stuff. The implications of the report would place the CAR on a short list of countries to adopt Bitcoin as legal tender. Yep, in September 2021, as we just mentioned, El Salvador Bitcoin law went into effect, establishing the crypto asset as currency alongside the US dollar. The Latin American nation is also preparing to create its own Bitcoin city funded by the $1 billion worth of Bitcoin bonds that we just talked about. So that is what's going on in CAR. I'm sure, and, it's interesting because when these stories pop up, we talk about it, and then the following, a few months later, it comes back up. So it's always interesting to talk about it now, and then you'll see an article later on diving into it, and you're like thinking, wow, I remember we definitely talked about that in comments. So something we'll be following on, and when we bring on certain guests, it may come back, up, especially if we talk a guest around blockchain or crypto work. All right, let's move on to the next. All right, so last article of the day. Now I'm going to kind of go into like security, my specialty, but it's kind of like always have to. I'm going to start like trying to bring in a security article at the end, at least one per show. Try to do that, depending on what we find or what's happening for the week, so we keep it dynamic. All right, but listen, this one's very interesting, and it's a couple of lessons that we should learn from this. Over 300,000 internet exposed databases were identified in 2021. The cybersecurity firm Group IB identified more than 91,000 publicly exposed databases in the first quarter of 2022, significantly more than the previous year. In 2021, the firm discovered a total of 308,000 exposed databases, with more than 165,000 of them found in the second half of the year. Most of the exposed databases use the Redis database management system, 37.5%, followed by MongoDB, 31%, and Elastic 29%. So, improperly inventoried internet-facing assets such as database can be exploited in cyber attacks, leading to costly data breaches. Last year, IBM found that the average cost of the data breach exceeded 4.2 million during the COVID-19 pandemic, up 10% from the previous year. The average time to identify and address a breach has increased as well to 287 days. One more stat that I'm going to get into some other stuff. While the number of exposed databases has increased, the time it takes for the database owner to fix the issue has remained the same as a year ago at 170 days. So listen, few things on this topic. So, why is it increasing? And let's kind of break that down and think through it. We're at a time where, I mean, we mentioned earlier, right, in the first article we talked about with the Alkami and the Federal Credit Union, right? They're leveraging the digital services of Alkami. Alkami is their platform is built on AWS. What does that even mean? So you have a time where a lot of banks, financial firms are leveraging cloud services. That's a fact. FinTechs, especially, cloud first all the way. That's a fact. How does that impact security now? So these databases are back in the days it was, and in some cases still it's here, but especially you talk about like 15 years ago, even 10. These databases were on-prem on your on-prem, meaning in your building or that you control. Now it's in the cloud. So now you're leveraging these services like a MongoDB, like a Redis, and so forth. So it's launched outside of your environment. And what does it take, right? So if it's exposed to the internet, meaning that it's public. It's not private. It's not like in a private subnet. It's in a public subnet. That means, from right now, I can go on my website, go to a certain URL, and I'll get a login screen. Extremely, extremely dangerous, right? These things should not be exposed. They should be within a private, we call it, you're dealing with AWS, you have like a VPC and so forth. The easiest thing to do, right? If you manage this, if you have access to these, if you're leveraging these types of cloud-based databases, just Google security best practices. Seriously, like it's that straightforward. And what I would put the vendor and security best practices in, and it's gonna basically detail now a bunch of best practices that you could adhere to, right? And then the issue or the work is actually implementing that into your process. But having a database publicly exposed, that doesn't necessarily mean that because it's publicly exposed, it's automatically going to get breached, but it increases the chances now, right? Versus something that's private, that's not publicly exposed, that's behind or behind like a VPC, some sort of wall. So in the article, it mentioned that, of these publicly exposed databases, I think the percent was, hold up a second. The percent, I'm going to get my percentages right. 31% of the number was Mongo, right? So a simple Google search, you Google Mongo security best practices. One of them, right, it says limit connections to the database. One way that data leaks occur is that an intruder gains remote access to the database. By limiting remote connections to the database, you reduce this risk. The best practice is to allow connections only from specified IP addresses, a practice known as whitelisting. With MongoDB Atlas, the fully managed service for MongoDB, each Atlas project gets its own VPC. So virtual private cloud, I think that stands for. For additional security, customers can enable VPC pairing to private networks housing their applications to prevent access over the public internet. So they clearly state this in their security best practices. Apparently, the 31, the thousands of databases that were exposed are not following this. You're part of the VPC pairing. So you're pairing whether your application is running on a AWS or Azure. It's basically being paired to the Mongo DB Atlas in this case. So that means that's the only application that can access it. There's a connection there. They also mentioned whitelisting specified IP. So that means you put only these IP addresses can get access to it. Not everyone, just these. So it's clear, and these security best practices are pretty ubiquitous. It's not only you don't have to only apply it to Mongo. It's just different cloud database services that are online. You could apply this to. So kind of wanted to end on that. I found it to be a very interesting stat in the way of the world. Like a lot of FinTechs, a lot of just various companies are going to the cloud and have cloud-based databases, but are they adhering to the security best practices? Cool. So I have a LinkedIn user. I think this one is Medina. She always comes in as LinkedIn user. Have you seen that? Let's read this question. Have you seen that cost a big surprise for organizations that opt for cloud versus on-prem? In addition to the insufficient security configurations, have you seen that that cost? I don't fully understand the question. I'm gonna try to take a stab at it. But I hope I'm right. So have you seen that cost as a big surprise for organizations? All right, I'm gonna interpret it the way I'm reading it. So I'm looking at it like, are you seeing that it's a debate of on-prem versus cloud database services? Look, on-prem databases have been breached also, right? So, and a lot of these breaches happen because people or organizations are not adhering to security best practices. Wait, I think the question came again. One second. Let me put the other question. Maybe it might be over clear. Have you seen that costs are a big surprise for organizations that opt for cloud versus on-prem in addition to insufficient security? Um, what I've seen, just from like newer age firm, I don't know if it's just more so you can take a few things, right? So it costs in terms is different types of costs. Look at operational costs, right? Um, if all I have to worry about, I'm a startup or a small company and I'm launching to the cloud, even if I'm a bigger company, whatever. Uh, if I'm handling the database on prem, what does that mean, right? Not only am I managing the actual development functionality and the data science and all the actual development, the data development work, right? Like I have to also be an administrator to that. So I need to think about the server. Um, I need to think about the server. I need to think about tuning the server. I need to think about updating it. I need to think about all these different things, right? So it's not only it's more of an operational overhead. But if I now can leverage like a cloud service, I don't have to think about that. They're managing that aspect. What I have to think about is it's a saying that I love this. this AWS saying when they talk about the cloud, and I think it can apply to anywhere, any cloud service, right? The vendor handles security um, of the cloud, and the user handles security in the cloud. So it's like securing the login, making sure that that database is not publicly accessible. All these practices, that's on the user. The actual now, hardware, the patching, all that, that's on the vendor. So I think that's like the biggest difference. It's like, especially when you're in launch mode, if you're trying to stand up a new service, it's who's handling the operational overhead. Uh, Most companies rather put that off into the vendor, like whether one of these database cloud vendors and so forth, rather than handling that on their own. So I think in terms of the operational overhead, because it's not like just the numbers and staffing, and all those different things. I hope that was the question that I answered. I hope that was what you that was my answered your question, or because I don't know if I got the question correct, or read it correct in my point of view. So let's see, because she said, have you seen that cost or a big surprise for organizations that opt for cloud? I personally is more operational overhead. If you want, especially if you're in startup mode, or you're trying to stand up this new service or so, it's like how to get there faster. How many do you want to hire someone to actually, or hire a team of people to manage that, the actual server itself and all the hardware that comes with it, or do you want to outsource that aspect and just manage your data and your business functionality? But regardless, well, I just want to make the point from a security standpoint, whether you are on the cloud or on-prem, there's security best practices you have to adhere to. So if you're on-prem, patching is a best practice. You have to keep your systems updated with the latest patches and a whole bunch of other slew of stuff. If you're in the cloud, there's a whole bunch of security best practices that come with that. It's adhering to them, implementing in a process that you're doing that efficiently and constantly. So I want to ensure that. All right. And yeah, Medina, thank you for the question. Really appreciate any questions, guys. Just feel free to chime in at all times. Really appreciate your questions. Hold up. All right, cool. So that concludes another episode of the Tech Behind FinTech. I'm going to give it a second because sometimes when I end abruptly, where I end, I see a question pop up. So I'm going to give it a couple of seconds to ensure. And in that meantime, I'll give you some quick updates. So number one, Tech Behind FinTech every Friday, 12 p.m. Eastern Standard Time. It's number one. Number two, you can visit us at the techbehindfintech.com. We have, if you're on Instagram, you can watch it. Obviously, on Instagram, you're getting the behind the scenes footage. But if you go onto YouTube, LinkedIn, Facebook, or the website, you'll get the actual the full show and the screenshots and the decks we put on. And when we have guests, also, if you're on Instagram, you only see me. But if you go to those other platforms, you'll see myself and the guests and get to hear them. So definitely, I launched it on Instagram just to spread awareness of the show. But definitely on these other platforms to stream it live. To all the people that commented, Medina, Jason, thank you very, very much. We love your comments, questions. It helps create a full discussion. To all the viewers on YouTube, LinkedIn, Twitch, Facebook, Instagram, thank you for tuning in. Really, really appreciate it. Stay tuned for our next week's episode at 12 p.m. Eastern Standard Time. And on that note, we are out. Have a happy, enjoy the rest of your Friday. Enjoy your weekend. And once again, thanks for tuning in. Cheers.